G'day, Adam Grocke from Johnston Grocke, just here with the finance update. There's been lots happening, which is great. The first that everyone knows about is interest rate moves. So there's been 2 interest rate cuts, which has been fantastic. A lot of the banks have passed on the full rate cut or close to the full rate cut. So that's really good news because we were a little bit concerned that they'll hold some of that rate cut back. Now, that brings interest rates down to, again, record all-time lows, and we're seeing some interest rates, some 3-year fixed rates at 2.99%, which is just mind-boggling to think that money is that cheap at the moment. Really good for people that own mortgages. In terms of people that want to get into the market and buy property, the rate cuts actually don't have much of an impact on them at the moment. The reason being is because the Royal Commission meant that affordability for loans was a lot stricter. This meant that people can't borrow as much money as what they used to. Now, the rate cuts are fantastic for people that own mortgages, but people that want to actually go and buy property, this doesn't increase their affordability until APRA, who's the governing body of the lenders, has come out and said that, look, we've probably gone too far with the pendulum and we've gone too tight in our credit assessment and policy. So what we're now allowing you to do is assess all the new loans and existing loans at not the 7 or 8% interest rate that we've applied before, but instead of that being a floor or an assessment rate, you're allowed to assess it at the current rate you're going to offer plus 2.5%. So what that means is, historically, over the last 12, 18 months, if I wanted to go borrow $400,000 to buy a property, my loan repayments that I need to afford are assessed on an 8% interest rate, which is just, that's more than 2 times what the current interest rate is. Now, if I can achieve an interest rate of 3%, I'm actually going to be assessed from a loan repayment perspective on 5.5%. So this is a fundamental shift in the way that we've been looking at loans over the last 18 months. It's great news because it's going to stimulate the economy. The banks haven't yet come out and adopted it because it's only 4 or 5 days old. We'll give you some more updates as this unfolds, but this is going to be one of the most biggest credit loose things that we've seen over the last 18 months. So we've been in such a credit tightening environment, and now we're starting to see the light at the end of the tunnel where things are going to loosen up and we're going to see more activity. People can borrow more money, which is still responsible lending because I think we went ultra conservative. So it's fantastic news, and we think that this is going to give some sort of stimulation to the real estate market over the next 6 to 12 months. We'll catch up soon. If you've got any questions, let me know. Have a fantastic day. Winter's here, and we'll speak soon.